Okay, thanks to the organizers for inviting me to this awesome conference. Really excited to tell you guys about debt covenants. Okay, so the motivation for this paper is that we really don't have a great understanding of the value of covenants. But I want to back up a minute and talk about what are covenants. So covenants in debt contracts are anything that goes beyond kind of what we normally think of as debt, which is this contingent claim that either pays in full or defaults and is associated with the transfer of control rights in that case. But in reality, debt has all these other kind of fine print in it, and that fine print limits the control rights and changes what firms can do. Broadly, this is thought to protect the value of debt claims, but theoretically, we think it could also create value by mitigating agency conflicts between claimants in the firm, like equity in debt or managers in debt. So in this paper, I'm going to kind of take a stab at addressing how much value is created by debt covenants. And I'm going to do that by looking at firms' revealed preference decision to refinance callable corporate bonds. So why is the refinancing of corporate bonds informative about covenants? So refinancing, like a mortgage refinancing, is usually about interest rates. When interest rates fall, fixed coupon claims, their option to refinance them is in the money. But it turns out that in certain cases, that's going to involve large changes in the covenants facing a firm, particularly when firms go from investment grade to high yield or vice versa. So there's going to be a trade-off between interest rate savings on one hand that a firm could get from refinancing and kind of the shareholders' desire to shed or avoid covenants in their new capital structure. So there's going to be this trade-off, and I can use the trade-off to quantify something about how firms feel about having or not having certain types of covenants. And kind of the tricky thing here is that covenants don't just create value, they also change the distribution of value between equity and debt claimants. So I'm going to have to use kind of a simple model and a simple framework to sort that out, and I'll show you how that works. So just to show you that I'm not totally making this up, Moody's has written about exactly the issue I'm talking about, which is that investment-grade firms, their bonds issued by investment-grade firms typically don't have covenants. And this makes sense because these firms are very unlikely to default, and maybe putting more restrictions on what the firm can do actually might destroy value if we don't think the incentives of those firms' management is misaligned with total firm value. But on the other hand, when these investment-grade companies fall to speculative grade, the flexibility afforded by the covenants in their current debt actually becomes a factor in their decision to refinance. So that's exactly the factor I'm going to be looking at in this paper, and I'm going to be using data on when firms refinance to quantify something about covenants. Okay, to give you a brief outline of the talk, there's going to be a simple framework that I'm going to show you about how exactly I'm able to do this in the data. Then I'm going to show you a little bit of supporting evidence. First, I'm going to show you there is really a big difference in covenants between investment grade and high yield bonds. And second, I'm going to show you that it really does seem to matter for when firms pull the trigger on that exercise of the option embedded in their callable debt. And finally, I'm going to kind of use that same variation in a kind of a parsimonious structural model. I'll use structural in quotes, and I'll explain why. This is not a full-fledged dynamic model of firm capital structure. This is mostly a statistical model of how firms behave, where there's one kind of dynamic decision, which is when the firm refinances. And I'm going to estimate that model to say something about the value created by the restrictive covenants found in high-yield bonds for high-yield firms. Okay, just to summarize the results briefly, I do find that firms behave as if they think covenants matter for how they behave. They seem to want to avoid adding new covenants at some times, relative to what you'd expect if covenants didn't have any value. And then through the lens of the structural model, I find that thinking about a speculative grade firm, right? This firm, if it had the same capital structure but lacked the speculative grade covenants we see, the firm would have about 2.4% total value less, which means that there's the agency conflicts of debt are reducing value in this counterfactual state. On the contrary, I can show you what would happen if we forced all corporate bonds to have the strict covenants that we see in high yield bonds. And in that case, the investment grade firms would actually be worse off because kind of what you'd think is these firms are not encumbered by agency conflicts, but we're forcing them to limit their own flexibility. Okay, so here's the conceptual framework. Just starting off with a very simple two-period model. There's going to be a firm that has two actions it can choose between, and there's going to be two states of the world that are realized, H and L, high and low. Okay, so action B always gives you X for sure, and action A gives you, in the good state, it gives you X plus delta, and in the bad state, it gives you that, but only with some probability Q. Right? So there's some risk if you choose action A in the low state. And I'm just going to set up these parameters so that given the amount of debt that there currently is on the firm's balance sheet, there's going to be this agency conflict, which is that even if state L is very likely, the firm is still going to want to choose action A because there'd be more value to equity. So this is kind of a classic risk shifting problem. You can think of it that way. You can also think of it any other way the conflict or the incentives of equity and the total firm diverge. It doesn't matter what your preferred story is. So I'm going to think about covenants in a very simple way in this framework, which is that we can't have a perfect contingent contract in the world. We can't say exactly what the firm can and can't do in every state of the world, but we can ban things from happening ever. So in this model, the covenant is going to be something that bans action A in all states of the world. And you can think that's pretty good if the probability of being in the low state is high. And that actually is pretty bad if the probability of being in the good state is high, because in the good state, you're for sure getting this higher value. Okay, so that right off the bat tells us that there's some surplus or value created by the covenant that's a probability, that's a function of the probability we're going to be in this good state. So that implies, though, that there's this threshold for what's the riskiness of the firm or what's the likelihood the firm's going to be in the bad state determines when this covenant is optimal. So now let's think about refinancing and how that relates to this. So let's imagine that at time t equals 2, the firm has experienced a change in the risk-free rate and a change in the probability that's going to be in that low state. So we have this debt outstanding, but that debt can be called, and that debt can be called for returning the face value plus some call premium. Okay? So there's going to be the decision of the firm is should we refinance this debt or not, and you can think about that decision as being split into 4 categories. Right? It depends on if the probability of the firm going into that low state has crossed this boundary for which the covenant adds or destroys value. So these 4 states are basically if the firm has always been a good firm, which has a high likelihood of being in the good state. If it's always been in the low state, that's going to be an always junk firm. And then the fallen angel is one who used to have a low risk and now has high risk. And the rising star is the opposite. So what I can tell you is all else equal, in this model, if you think about what's the risk-free rate at which the firm equity holder is willing to refinance, the fallen angel firms require a larger decline in interest rates to refinance than the firms that have the same current risk but did not experience this downward decline. And the opposite is true for rising star firms compared to firms that already have that same level of current risk but did not have an upward increase in that risk, or a decrease in that risk. Okay, so let me explain in a graph why that's true. So think about just plotting the value of debt as a function of the risk-free rate. This is just bond math 101. When the risk-free rate rises, the present value of the fixed claims discounted at that rate falls. And let's imagine this is like the always junk firm's debt, so that debt has the covenant. Now, CP is going to be the call price the firm has to pay to refinance the bond. So this firm is only going to refinance when the value of its outstanding liability is higher than the price it can pay to expunge that liability from its balance sheet. Okay? So the firm is only going to refinance if it's this always junk firm to the left of this line of the risk-free rate. Now, if we think about the hypothesis that covenants protect value of debt by limiting agency costs, by limiting the firm's ability to erode value by selling assets or gambling for resurrection, then think about a similar debt obligation but without any covenants. This is supposed to be animated. There we go. So that's going to be this red line. And you can see right off the bat from nothing else, since that debt is less valuable because it has more flexibility for the firm to erode recovery, that debt is just mechanically from that going to have a lower boundary for which the firm should refinance. Why would the firm refinance at this old threshold? It would be giving up this value, this differential value between the call price and the value of that debt. Okay? However, there's supposed to be another animation there. However, what we actually see in the data is something different. We see in the data that firms, instead of refinancing over here, the fallen angel firms actually seem to push forward a little bit. Okay? And why would they do that? Well, why would they be giving up this difference between the black line and this red here? It might be that they know that by adding covenants or rearranging their capital structure, assuming that debt is priced fairly, once they restructure their capital structure, the firm is now, the equity holders are now fully incentivized to capture all the value of aligning their capital structure. So if covenants do add value to the firm, then the firm will refinance and overpay to get that old debt off its balance sheet, as long as the value that they created by the covenants is at least as high as the amount that that firm is overpaying to refinance that debt. So in a nutshell, basically what I'm saying is I can see in the data the different refinancing behavior as a function of the moneyness of the refinancing option. I can see using a simple structural model and bond pricing data, the difference in the value of bonds that are kind of issued by the same firms with the same current risk, but either have covenants or don't, because they're a legacy firm that was investment grade and fell to junk rating. And those two things are going to imply, right, these things together are going to imply what's the value of covenants as perceived by those firms. Okay, so let's go to supporting evidence. I'm just going to show you a little bit about covenants in bonds. So pretty much all bonds have something that's called a negative pledge covenant, which effectively protects the seniority of bonds on the balance sheet and prevents them from being diluted by other debt kind of senior to them, or additional debt that's senior to them. But if you look at anything in corporate bond covenants related to new debt issues or other debt that's stronger than negative pledge, so restrictions on new borrowings, for example, these only show up in high-yield bonds, right? Bonds that are issued at high yield. Restricted payments that limit what the firms can do with their free cash flow, like they're forced to pay down their debt or they're not allowed to pay dividends or do share buybacks, these only show up in high-yield bonds. Covenants that limit the flexibility of the firm to issue debt in different subsidiaries of the firm only show up in high-yield bonds. Covenants that govern asset sales, so preventing the firm from taking some of the capital or collateral that might be available away or only show up in high-yield bonds. And then I can also show you within a firm, right? So this example comes from American Axle. The reason I figured out this was I had printed out a bunch of bond indentures, and I noticed that some of them were a lot thicker than the others, and it turned out those were the high-yield ones. And then I figured out, I was like, what is explaining this page count difference? And it turns out it's the covenant section. Okay, so this is the covenant section of the original American Axle debt that they then refunded into an investment grade issue, and they just stripped out all of these incurrence covenants tests that are in the high-yield indenture. So pretty much that's the difference. In high-yield bonds don't have these incurrence covenants tests, whereas investment grade bonds don't, but high-yield do. Okay. So next, what I want to do is I want to move to this test. You know, if my kind of thought framework is true, then there should be some difference in observable refinancing or refunding patterns as a function of if a firm's new debt is going to have to contain covenants as the industry standard when it currently doesn't have them, or if it does have them now and it's able to refinance into debt without. Okay. So the way I'm going to do that is by writing down the simplest possible callable bond pricing model I could think of, which is I'm going to use, as we saw yesterday, this Duffy and Singleton short rate process to model risky debt in the kind of in the risk-free pricing framework. Okay, so all we have to do here is think, what's the default adjusted short rate process for a firm? I'm going to assume that's an AR1 process. And I'm going to say the way to think about this pricing model is the firm is solving for the optimal call time that minimizes the liability it has. Right? So the firm is just going to keep paying coupons until either they pay the call price or the bond matures. And they're going to choose the optimal time to refinance that maximizes the value of their option to refinance or equivalently minimizes the value of that debt. Okay, so here's what I do when I take that model to the data. I come up with basically an empirical estimate of this default adjusted short rate process for every firm in my sample over time, and I plot that in red. And in blue, I plot the optimal exercise boundary that's defined as what is the maximum default adjusted short rate level at which it's optimal to refinance. So the refinancing is this boundary strategy where you only refinance if your cost of capital is low enough to replace that bond. And the reason you see these big dips here is because the call price schedule of most corporate bonds issued in my sample has these declines in it every year. So if the call price of the bond is about to fall by 100 basis points, it really doesn't make sense to refinance that bond the day before the call price falls. So what you see here, this is America West Airlines. You see my credit model is picking up increased market implied default risk around September 11th when the airline industry took a big hit. And then you see this firm actually should refinance when this red line crosses the blue line, and my black vertical line shows that they indeed do refinance. That's my indicator for when the firm calls this bond and issues a new one. Let's look at a different example. Let me make sure I didn't skip one. Yeah. In this example, the firm actually waits too long. Okay? It should have refinanced here, 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 and all these months, and it finally does over here. In this example, this is Kroger grocery store. Kroger is actually a rising star issuer, so this is a high-yield debt issue, and they refinanced this bond at the first possible time the bond was callable. So most high-yield bonds have this thing called a non-call period, and then my graphs only start with the optimal exercise boundary when that call protection expires. So the question is, is there anything systematic about these things I've shown you, right? Do fallen angel firms go too long according to an interest rate only model, and do rising star firms jump the gun and they refinance even though there's time value left in the option to wait for interest rates to fall further. So the way to think about that is I'm going to say, okay, I don't know exactly what the true optimal boundary for the firm is. I have my measured one that was computed just under the assumption that covenants don't matter using this simple bond pricing model. I'm going to say maybe there's some model misspecification that relates to if that firm is going to shed or pick up high yield bond covenants. So I'm going to say, okay, using the revealed decision of the firm to refinance, which I can see in the data, and my observed measure of the firm's default adjusted short rate, I'm going to say, okay, maybe I can explain deviations from my model with if the firm is a fallen angel or it's going to be a rising star and therefore is going to change the covenants in its capital structure. Okay, so basically what I do is I take this model to the data, and I find that fallen angel issuers on average wait 48 basis points more in terms of this default adjusted short rate before they refinance than the equivalent kind of always junk issuer. So I'm not really leaning on my model to be perfectly pricing the option. I'm just kind of hoping that any differential behavior in the high yield versus the always junk versus fallen angel is attributed to the difference in covenants. And what kind of gives me comfort is, yeah, in this direction, the fallen angel delays, but the rising star firms actually jump the gun by 56 basis points. So they have some time value again left in their option to wait for interest rates to fall further, and they give up that time value and instead refinance to an investment grade bond with no covenants early. Okay, so that doesn't tell us really anything about magnitudes. If you think back to my picture before, that only really showed us that one dimension of the problem, which is how firms shift their refunding timing. We also need to combine that with information on kind of the value of debt as a function of if it has covenants or not. And then I'm going to do that in a simple structural framework that allows me to estimate what's the value created by these restrictive bonds. So I'll kind of show you exactly how I do that. Okay, so the environment's going to be super simple. I'm just going to take most things in a statistical framework. There's going to be this infinite horizon environment in discrete time. The firm is going to just continue operating in a very dumb way. Cash flows are going to keep coming into the firm until it first defaults, and then the firm's done. There's no recovery in the model, but you can think of me just adjusting the default probabilities to reflect recovery, and it's all equivalent. The firm's only job here is to service its fixed coupon debt and endogenously refinance that debt, subject to varying interest rates and also varying credit quality. So the firm's credit quality is going to vary exogenously in the model over time, and that credit quality is going to fluctuate between investment grade and high yield. And the firm's going to understand that if it falls to a high yield, when it refinances, its new debt will have covenants, and and vice versa, if it's investment grade and doesn't have covenants, or sorry, if it's already high yield and has covenants and rises to investment grade and it refinances, those covenants will go away. So what does that mean? Well, the important thing in this model is that covenants affect the cash flow distribution of the firm. That's how I'm going to think about it. Right? So every period, the firm is going to earn some cash flows, and there's going to be an extra bite if covenants don't exist. So my gamma is just an indicator for if the firm is subject to covenants in its capital structure or not. So we're going to get, in kind of flow terms, we're going to get a constant amount of money every period, and then we're going to get extra if the firm doesn't have covenants, and all these are going to be able to depend on what the state variable of that firm is, which reflects the credit risk of the firm. There's also a probability of default, and that probability of default, I'm going to say, is a function of the firm's credit risk or credit rating, and also there's an extra kick for if the firm lacks covenants. Okay, so basically what I'm doing is these F parameter and this S parameter are shifting around the distribution of cash flows in the firm, and that shift in the distribution of cash flows, you can think back to my initial toy model, right? It's going to change the distribution of value between equity and debt in the firm, and it's going to create a difference in alignment of incentives between equity holders and total firm value. The firm is going to service debt, so it's always going to either pay a coupon if it doesn't refinance, or if it chooses to refinance, it's going to pay back the bond. Okay? There's two state variables in the model. The risk-free rate evolves as an AR1 process. And XT, you can just think about this as the credit rating of the firm. That's going to evolve as a Markov process. Okay, so what's the firm's objective in this model? The firm's objective is just to maximize equity value, but the firm doesn't really have that much control. The only thing it can do is choose when to refinance its debt. Refinancing is going to affect the random default time, because if it goes to a capital structure without covenants, that's going to change this probability of default, right? And then it's also going to affect the the cash flow distribution of the firm, right? Because the refinancing is going to affect if the firm does or doesn't have covenants, which I said is going to affect how these cash flows are coming into the firm. Okay, so similar to this statistical model, this model has also an optimal refinancing policy that's a function of the risk-free rate in the economy. So it's only optimal to refinance in this model if the risk-free rate is below some model-implied exercise boundary. And that boundary is going to be a function of all the unknown parameters in this model and the state variable, this x. Okay? I'm going to make some assumptions that allow me to efficiently compute this, and I'm going to set it up as a numerical way to compute it. Okay, so a simple parameterization of this model is I'm going to take the state variable for credit ratings and just discretize that into 8 bins. 4 of them are going to be investment grade, and 4 are going to be high yield. I'm also going to simplify the cash flow process. The firm is going to get this average cash flow every period, and then it's going to get one extra kick, this flexibility, you can think about it, from not having covenants if you're high yield, and a different one if you're investment grade. And that's going to reflect what I see in the data, which is that investment grade firms maybe benefit differently from not having covenants than high yield firms do. I'm also going to assume, just to simplify the credit risk structure in the model, that you only default once you're in the lowest credit risk state. You can think of state 8 as the default state, and you could also think of P plus S as kind of the expected loss given default. So this S is going to be an extra risk of default if you don't have covenants. And the goal here is to kind of estimate these 4 parameters structurally, because those 4 parameters are the ones that affect the distributions of cash flows, and that's going to allow me to do a counterfactual exercise to see how the value of the firm is a function of if it has these covenants or not. And this model is identified by looking at the firm's decision to refinance and the price of bonds in the secondary market. Okay, so just to give you a sense of how these parameters are identified, I'm going to explain a major source of the identifying variation for the parameters that govern kind of the flow benefit of not having covenants. So what I've done here is I've plotted in a kind of a stylized hypothetical firm in the model. I've plotted this parameter. I've ranged the FHY, the high yield flow parameter, and I'm plotting on the y-axis what's the optimal refinancing boundary for that firm in terms of the risk-free rate. How low should the risk-free rate go to refinance? And what you see here is this fallen angel firm. The higher the benefit is, the flexibility benefit of not having covenants, the more likely it's going to delay refinancing relative to this always junk firm that already has covenants and will still have them if it refinances. The opposite is true for investment grade firms thinking of refinancing. The bigger the benefit to not having covenants is for investment grade firms, this rising star is going to jump the gun, right? They're going to refinance at a much higher interest rate. Similar identification works for the kind of the S parameter, which affects the increase in default risk, but that's more linked to the prices of corporate bonds. So this harkens back to the kind of the simple static model, right? What I showed you was in the data, the difference in refinancing boundaries between different types of firms identifies some parameters, and the difference in value of the corporate bond identifies. Together, these all identify the surplus created by covenants. Right? That's exactly how this model is working. I just had to make the model more complicated to account for the real-world dynamics of corporate bonds and how they're actually refinanced. Okay, so to estimate this, I'm going to take to the data the observed refinancing decisions of corporate bonds and also their prices, right? Because prices are going to show me the difference in value of bonds with and without covenants, and the observed refinancing decision is going to show me, again, how much firms are jumping the gun, and those together are going to show me how much value is created. Okay, so I'm just going to do this in a simple maximum likelihood framework. I'm going to calibrate the rest of the parameters in the model, the risk-free rate process. The asset returns are scaled to match kind of CompuStat flow, EBITDA. The ratings transition matrix in my model is taken from Moody's. I can do that either in a risk-neutral or physical probability measure. It affects the things a little bit, but not qualitatively. And then again, I'm estimating these 4 parameters: the probability of default with covenants, without covenants, and this flexibility of having loose covenants. Okay, so here are the results of the baseline structural estimation. They're not really interpretable. I mean, basically what you see is there's a positive benefit of flexibility of not having covenants in terms of cash flow, and not having covenants also increases the probability of default relative to having them. That's consistent with data on recoveries. If you look at investment grade firms, or firms that default that had issued investment grade debt, have a lower recovery value than firms that default which had issued high yield debt. Right? The lower recovery among firms that had issued investment grade debt basically is picking up this parameter S, which is that there's a higher loss or a higher likelihood of default when you don't have covenant protections. Okay, so what's more interesting actually is to look at what's the value generated by covenants, and I'm going to do that by just in my model. I'm going to say, okay, I'm going to write down what's the enterprise value of the firm in the model in the real world. So that firm is allowed, the credit ratings of that firm move around over time. That firm is optimally refinancing as if it's subject to real world covenants, such as when it refinances into high yield debt, it has covenants. When it refinances into investment grade, it doesn't. And I'm going to compare that to what the model implies for the value of the firm when we turn off covenants altogether. Okay? And I'm going to scale that by the enterprise value of the firm. I can also do the opposite. I can look at what if we force covenants onto investment grade firms. I'm going to compare the real world model implied value of the firm to one where the firm always has these restrictive covenants. And again, what's happening is the cash flow distribution is changing. Right? So the model is totally doesn't take a stand on if covenants add value or destroy value, but I'm going to plug into this model those parameter estimates to see how that works. Okay, so the results from feeding my estimated parameters through this counterfactual and using the delta method to compute standard errors from that is that speculative grade firms, if we force them not to have covenants, they'd be about 2.4% less valuable than the current firms as they stand in the model. And investment grade firms, if we force them to have covenants, would be at 1.3% less valuable. So those are kind of my baseline quantification of what's the agency cost of debt that's solved by covenants. So there's one thing missing from this model, and I actually haven't finished doing it yet. I was hoping I would have. But there's basically, in a normal firm, there's two parts of the capital structure, right? There's like a senior loan. We saw this yesterday in Mike's discussion. And then there's the high yield bonds. I'm only looking at high yield bonds. And so it's natural to ask, like, if there are more covenants in loans and these covenants are strict, they're maintenance covenants, how does that affect my estimation? And kind of the answer to that is that senior covenants can only be trusted to protect senior debt. What happens when these covenants are violated is that there'll be kind of an exemption made or resolution to that violation. They'll waive the covenant violation. And often that'll encumber the bonds. That'll make the bonds worse off because they'll allow the firm to keep borrowing above the bonds in the capital structure. So bonds get pushed further down. So what I'm working on is kind of adjusting this model to reflect the fact that there is some senior debt and kind of rescaling the estimates. But I expect them to, if anything, go up a little bit. Okay, so let's think about the magnitudes I got. So I got this number about 2.4%. There's two papers in the literature, one by Jules, which says that kind of let's look at from a kind of a static trade-off theory perspective. Let's look at what's the net benefit of debt. So there's tax benefits on one hand, and there's kind of distress or agency costs on the other. And these papers find between like 3 and 5% of firm value that is the benefit of debt. Right? So what I'm saying in this paper is that these are taken from the real world, right? The real world capital structure with covenants that we see in the data. But if these covenants weren't in place, these numbers would be substantially closer to zero, right? Because these are the net benefits of debt, the tax benefits minus the agency costs, and I'm estimating compared to a counterfactual where there's no covenants, that the covenants add about 2.5% of value. So I don't know if 2.5% of firm value is a big number, but I do think kind of in the context of these estimates of the net benefit of debt, we might see capital structures of firms look substantially different if there weren't covenants available for high yield firms. Like high yield firm leverage wouldn't really add that much value if we weren't able to put these commitment covenants in place to prevent further borrowing or to prevent risk shifting or asset substitution. So in that sense, I think they're quite valuable in a sense of explaining the observed capital structure we see. Okay, so again, I just want to conclude this paper uses a novel framework to assess what's the value created by corporate debt covenants. I find this value is pretty large and actually could explain capital structure when you think about it from the perspective of what is like the net benefit of debt. And the fraction of that that's added by covenants is quite large. Okay, thank you.